All right, good afternoon, everybody, and welcome to another Hamilton Wealth Partners Fund Manager webinar. My name is Kane Barano, and I'm a partner at Hamilton Wealth. So today's webinar will be similar to previous webinars. So I'll begin by reading a brief advice warning. I'll then introduce our guest speakers, and they'll present for about 15 to 20 minutes, and we'll open up for questions at the end. But do feel free to submit any questions you have in the taskbar below throughout the webinar. So just quickly, the information contained in this webinar has been provided as general advice only. The contents have been prepared without taking account of your objectives, financial situation, or needs. You should, before you make any decisions regarding any information, strategies, or products mentioned in this webinar, consult your advisor to consider whether that is appropriate having regard to your objectives, financial situation, and needs. So today I'll be joined by Andrew Papageorgiou and Ken Liao from Realm Investment House. So Andrew co-founded Realm, and he's also their head of bank capital and corporate credit. So over the last 20 years, Andrew has gained considerable direct investment experience, primarily in domestic and international equity markets, derivatives, direct infrastructure, real estate, private equity, domestic hybrids, and convertible bond markets. Ken Liao is a partner at Realm, and he's also their head of strategy and risk. Ken joined Realm in 2013 and has over 26 years of investment experience. Ken has previously held responsibilities as the CIO of domestic equities at BlackRock, where he led a team which built the Australian quantitative equities business from inception and served as the chair of the Risk Management Committee and member of the Executive Committee. Prior to BlackRock, Ken was head of the investment research at Mercer. So with those introductions, I'd like to hand over to Andrew and Ken to introduce Realm and provide us with some information on their funds. So over to you, Andrew and Ken.
Thank you so much, Kane. Thanks for the introduction, and very nice to have the opportunity to speak to your clients today. Good afternoon. So just by way of introduction to Realm, as Kane's mentioned, we were formed in 2012. It remains an entirely private ownership structure. We've grown from humble beginnings to a sum total of $1.4 billion today, which we're very grateful for. In terms of our approach, everything we do comes down to a very small number of factors that you'll find is common throughout all the processes that we have. We have a very strong set of quantitative tools that we utilize to assist us in our decision-making, but we are not a quantitative house. There is no single formulation, no algorithm that passes straight from the markets and into our trading, without first passing through our funds management team. Think of us as fundamental managers using a range of quantitative tools to support our decisions. We're also highly contrarian in nature. What you won't find is that when yields are low, you will not find us taking more risk in our portfolios to generate the same expected return as you might have had a year or two ago when yields were much higher. We don't go and seek more risk to deliver a set targeted return. We do quite the opposite. We take more portfolio risk when the opportunities present themselves, and we take less when there's less to offer. Thirdly, you'll find that we have a certain style of investment which appears very opportunistic. We're able to get set quickly and move our portfolios around in a very fluid fashion as circumstances evolve. For our multi-sector funds, like the Short-Term Income Fund or Realm High Income Fund, we're very strong on our capacity constraints to make sure that this is always preserved and it remains a competitive advantage that we can pass through our clients consistently. We seek a certain kind of, a certain set of market inefficiencies to make returns, and these are clearly on your chart, but let me just touch on a few of those ones. If you look at natural habitats, just for example, and the first example being bank capital and structured credit. Consider a person who just walks into Commonwealth Bank and takes a mortgage. They won't know, but maybe that mortgage gets kept on Commonwealth Bank's balance sheet, in which case the risk of that mortgage is passed to Commonwealth Bank's debt holders, whether they be hybrid holders or tier 2 or bank senior. What Commonwealth Bank may have also done is sold that mortgage into a structured security called a residential mortgage-backed security, which is issued to an entirely different set of holders. But that mortgage, it's the same risk. It just happens to be sold into different markets. And there's different people operating in those markets, and the prices get out of alignment from time to time. So one of our jobs is to have a look at the relative pricing between those two opportunities and obviously buy the cheaper. If you go further down, and perhaps a simpler example might be onshore and offshore. So an organization like Westpac is typically a very big borrower in the market and can't meet its needs entirely from the Australian market. So it also issues debt out of the same entity, essentially, into the US and European markets. So for the same credit risk, the same pricing, if you like, there should be some relationship between the prices in Australia and elsewhere. So we look for distortions in that and obviously buy the cheap ones from our clients. So these are some of the features that we look for in portfolios and look to build portfolios with those opportunities. So with that, I hope that gives you a reasonable introduction as to what Realm Investment House is about.
Great, thank you very much, Ken. Well, I might start off with some questions. You know, we've got quite a few prepared. I've also got some pre-submitted ones. So actually, maybe just firstly, so how do Realm and others in your space, how do you remain competitive in such, in an alternative investment space in such a low interest rate environment? And what is likely to be the return sources going forward?
Couple of questions there to unpack. I'll take the first half of it. So, how we remain competitive. There are a couple of elements to that. A lot of them are actually covered up on this screen. One of them is actually design. Okay, design is really important because it actually allows you to access those opportunity sets, like allowing you to be contrarian, allows you to be opportunistic. So, what are the design features that allow us to be competitive? One is capacity. We're one of very few fund managers in the country to make active capacity statements around how much we can manage. Okay, so for example, the Realm High Income Fund, who we are very pleased that Hamilton Wealth were one of the first groups to show confidence and show trust in investing within that fund. Well, that fund is now in soft close, so essentially it is not open to new financial planning dealer groups. And now has its capacity essentially reserved for existing supporters. The reason why that's important is that fund size allows you to access a broader range of opportunity sets. It allows you to exploit some of the shallower pools and shallower markets, which frankly just can't accommodate very large dollar balances. Okay, so first instance, capacity. The second element, Ken spoke about being contrarian. Being contrarian from a design standpoint means that you have to have a strategy that is flexible enough and dynamic enough in terms of how it's run and managed so as to allow you to move the other way. So Ken gave the example that we will not chase our tails. We will not buy more yield we will not buy more risk, to target a level of yield just when the market is most expensive, because it just doesn't make sense. If anything, you actually want to be able to do the opposite. So it's very, very important not to essentially be benchmark aware, not to be constrained, not to have your freedom of choice and freedom of action constrained. But coming with that, you then need a lot of dynamic rules and dynamic gates around how you operate. And that's where, look, we're really fortunate to have some really great people involved. So Rob Camilleri and myself started it off in 2012. We roped Ken in about a year or so later, and he comes with a very strong quantitative background. I won't bore you with the line by lines there, apart from the fact that look, the one thing we have in common is clearly we're all handsome men. But outside of that, we come at the problem of how to manage money from very, very different, unique perspectives. And where Ken has been excellent for us is actually helping us dynamically manage for risk. Okay, because these portfolios, it's hard to run them through rules. You need some flex to be able to accommodate for the fact that the environment's ever changing. So that's been very, very important. Design being contrarian, size has been important, and active. We're really, really active. We take a view and we follow it through. We feel like we have a ground level edge from the perspective that we know how to hit the phones, we know how to use our relationships, we know how to build real insight around what's going on within markets from supply demand perspective. And really, it's a really nice synergy because Rob and I are, real practical bottom-up guys that, are really comfortable operating off the screens. But when you combine that with a really nice quantitative discipline, you get something that's quite unique and that we're quite proud of as well. So I think they're probably the key elements around why we've managed to be successful within the strategies that we've run. In terms of the forward outlook, I think I might just throw over to Ken.
Yeah, thanks. So, Ken, it's obviously a much more challenging environment today to create returns than it was, say, a year or so ago. So what we need to think about right now is clearly that liquidity support and quantitative easing are, in a process of being unwound at some stage. So what's very clear is when the yield curve control issues came in, when quantitative easing was added to the Australian market and bond market, when cash rates were cut to zero, certain asset classes benefited really greatly. So you talked about bank senior, for example, which is the most affected curve. If you looked at long dated credit, that was compressed a long way. So highly liquid, long dated credit that was highly rated benefited most from quantitative easing and other monetary operations. Now that tailwind is coming to an end. So the last place you want to be is in those areas. The most natural thing to then do is be in the places that benefited least from from the monetary tools that came forward. So what we're finding today is that even though that opportunity has pretty much come to an end, firstly, don't panic too much. It's not about to be unwound tomorrow. We're talking about a very gentle unwinding over the period of the next, several years, actually, with the first movements only happening perhaps in July, just the smallest movements, possibly a bit more, middle of next year. So no emergencies at hand right here. It's just looking for the best opportunities. So what's remaining? Well, it turns out the market still rewards quite highly things that are just a little bit different. So, for example, hybrid securities, for example, have got design features that don't make them quite the same as a corporate bond or a bank senior debt. That difference is still very well rewarded. In addition to that, you get situations like buying a mortgage through a structured product, for example. As I mentioned, it's really no different to buying, say, bank capital directly from Commonwealth Bank as opposed to buying its mortgage pool. It's pretty much the same kind of credit risk. To us, analytically, they're no more difficult. But because structured securities, if you like, are less common, a different kind of sort of skill set by some people's reckoning, the opportunities there remain very significant. And in fact, didn't really compress very much as part of QE. So unsurprisingly, what you're finding in our portfolios is that we're rolling away from the long-dated, more liquid type securities into these opportunities. Now, there are less opportunities available. Let me not get around that. There's less opportunities available today than there was before. But it's not by, a terribly large amount. Competitive returns can still be delivered. And in the context of a situation where cash is effectively zero, there's still good returns to be had.
Great, thank you very much. Maybe just on one of your early points about being contrarian, how can you give some, real life examples of how, you approached that last year when, when we saw quite a lot of volatility in fixed income markets, especially in March last year. If you could just provide some insights, that would be great.
I might just take the first half of it in terms of how we've proven that we've provided a proof statement around being contrarian. It wasn't just in March of last year. We were fortunate enough to exploit the sell-off in early 2016, for example, after having run risk reasonably low going into that sell-off. We were successful in being able to scale up into the corporate credit sell-off that occurred in late 2018, when everyone was worried about General Electric getting downgraded, and there was this massive concern around all these US BBB corporates being downgraded to sub-investment grade. And credit markets actually had a really, really bad 2018 on the back of that. So, we were able to lean in and do quite well out of that market dislocation. And then by end 2019, early 2020, we had actually taken the portfolio back into a pretty defensive position. And look, it's I don't want to use the word fortunate. It certainly wasn't fortunate that we had a pandemic before us, but by the same token, being contrarian, the other side of it is that you have to be willing to take reinvestment risk for periods of time. You have to be willing to start moving out of the market as the market gets dearer. And there are periods where you can stay underinvested for an extended period also. When we started selling our portfolio down or making a smaller target of ourselves in late 2019, early 2020, it wasn't, it was something we were doing with a full realization that we could be in that position for a year or a year and a half. There's nothing to say that sell-offs have to occur when they occur, but by the same token, it's also a flawed perspective to take the view that they won't occur. So when you start thinking that you need to position your portfolio a certain way because yields are going to zero, and the concern is where are you going to get yield from? I mean, that mindset is one that is very pro-cyclical, that would force you to be more and more heavily invested as yields get lower. Again, that's not what we do, and it does actually force us to, at times, accept lower returns, and certainly, unashamedly, there are times where within this portfolio, we are targeting numbers of below 3% over cash, because it's the right thing to do. If the market doesn't want to give you 3% over the cash rate, the last thing you should be doing is forcing it out of your book. Did you want to add anything to that, Ken?
Yeah, so look, we went into the COVID environment, as Andrew has mentioned. We were fairly fully set in the portfolio in mid-2019 and gradually unwound it into late 2019, or effectively at a low risk position into December, January 2019, 2020. In February, in January, COVID started being talked about, but it was one of those sort of left field things. You had a lot of things to worry about at that level. And something geopolitical, something going on, everywhere else in the world would be something like that. But by mid-February, we became quite concerned about it, and we're in a position to do some pretty advanced analytics kind of early. So by late February, we substantively started to de-risk portfolios, putting in a whole spread of protection mechanisms for ahead of what we felt would be something very large. At the time, I didn't know it would be this large, and we didn't know. Clearly, how could we? But we thought it'd be something like GFC-like. So we positioned the portfolio like that heading into March. That made us, that put us in a really, really good position when the world was really having a lot of troubles in mid-March. And we were one of the few teams out there with plenty of liquidity to go and absorb all the emergency selling that was taking place. So when things calm down and we start seeing trillion dollar package after trillion dollar package come out to stabilize the markets, provide a baseline to use the federal balance sheets, if you like, to carry across an economy over a chasm of that type. In April, late April, we became very confident that the economy would be okay. It would just take time, and that certain credits, particularly those ones which were like, what I call core infrastructure, stuff you had to have as a society to survive. We were happy to invest in those things very, very heavily. So we substantively re-risked the portfolio in late April, and as the markets came in, also sold our positions down to effectively a fairly low risk portfolio again, only about 2 months ago. Just to give you an example again of how we've managed the cycle.
That's really helpful. Thank you. Maybe sticking on the macro sort of themes. Taiwan. There's a bit of tension between Taiwan and China at the moment. And maybe also if you can touch on commodities as well. How do these sort of there's a lot of talk about a commodity super cycle. How do these feed into your positioning for the portfolio?
Do you want to take that? Okay, so Taiwan, geopolitical issues are popping up all the time. You can worry about all sorts of things, and the end of the world's around the corner. You just never really know when something can really go wrong. But rest assured, we look at these things. We bring in experts when we have to understand what's going on. For example, we're bringing in experts on Middle Eastern affairs when there was issues cropping up in Syria last year to explain what was going on and what our risks were. Again, we were comfortable after doing that, but you look at these things. So in Taiwan, it's obviously probably one of the most dangerous places in the world right now from a really large-scale geopolitical issue. The background behind that, I think, is kind of well known, but you have people saying that President Xi wants to reunify, what his notion of China is, in the period of his leadership. That comes about from some fairly tenuous remarks that get made, things like he doesn't feel these problems should be handed over from generation to generation. And there's some saber rattling. There's obviously some incursion of identified airspace that's going on. There are things to be worried about. And then you've got a situation where the United States is maintaining strategic ambiguity about its commitment, and it does so deliberately. It's a strange history about that because they maintained strategic ambiguity at a time when China was quite weak. It's just to stop, it's to provide enough uncertainty that they won't, that you have a fog of war type situation, you won't act too strongly. But US battle simulations now indicate that their edge over China is actually probably doesn't have too many years left, if that at all. In fact, if you look into the detail of those battle simulations, you'd find that they only won last year if they use technology that is not yet deployed, for example. So we've gotten to the point where the US actually knows that it cannot win a war. And so with the US withdrawing from its longest wars, it's hard to imagine that they would enter a war they cannot win in that circumstance, and it's kind of known. So what prevents Taiwan from being literally walked over right this very minute? Well, a couple of things only. There's only two really big things that are stopping it from happening right now. One is, as you know, one of the greatest shortcomings one of the greatest areas of short supply right now is in semiconductor chips. Anything from the chip that's in your toaster to the ignition for your car, or in fact, a semiconductor that goes into advanced computing. They're actually in incredible short supply right now. And the hard part about this is that it takes you years to rebuild one of these factories. Like 2 years of planning is required to build another high quality semiconductor producer. So Taiwan Semiconductor produces 84% of the world's advanced chips, can't be replaced. So one thing is the world is very concerned that that capacity to produce will be destroyed. Okay, so you've got this really precious asset that can hold you from a destruction type standpoint. The other thing that's kind of protecting them is that, you know, there is an implied security guarantee over Taiwan that if the US loses, well, how do you think India's going to feel the Quad? How do you think India's going to feel about it? How do you think, you know, Japan's going to feel about that? And it has implications about rearming and trade and things of that nature. So those are the issues that give Taiwan strength to not being invaded right this very minute, you know, from both angles. But the thing that sort of strikes me is the will for war within the Chinese nationals, and it's just not there. So around about a third of the population, typically the older generation, views themselves as Chinese. You know, it's like they happen to hold a Taiwanese passport, but they kind of identify as ethnically Chinese. And only half the population is prepared to go to war. You know, so there's no will for war going on in there. So the market at the moment, the market is not reacting to much news that's going on with Taiwan. If you looked at the figures and all that, it's not really doing anything. And the main reasons for that are war is talked about. There's a lot of saber rattling that goes on, but if it occurs, the possibility of prolonged kinetic warfare doesn't seem very high. So that's the way the market's reacting. We're not specifically protecting for that environment, but we have got other protections on the portfolio.
Great, thank you. And maybe also, are you able to just touch on, you know, there's been a lot of talk about a commodities super cycle. The last few days, we've seen, you know, quite a bit of volatility in commodities. Yeah, maybe just your thoughts on that.
No, go for it. Yeah.
All right, so we're talking about now really two sets of commodities, one being iron ore related and the other one being, you know, the most significant ones are iron and sort of battery related type activities. So iron ore is now over $200. It's quite interesting because the sort of financial forecasters, the official forecasters, like for example, the federal government in its most recent budget assumes that iron ore prices will drop from around about $210 per ton for our kind of iron ore to 55, not long from now, like another 18 months or so. So it's constantly assuming a reversion to a balanced market in a fairly short period of time. This is supported by the fact that China has stimulated its economy to come out of COVID, again, not via the consumer like we have, not via the consumer like the US or many other parts of the world has, but by stimulating its infrastructure again through state-owned organizations and other activity like that. They're just building stuff again. So they have been buying a lot more iron ore than they would normally. Their steel production is higher than it would be normally. They're importing steel at a higher level than they would be normally. This won't be sustained. So we kind of know that. That's the demand side. The supply side is to do with Vale, which is the other major sort of seaborne iron ore provider. They've had a problem with their sort of extraction mines. It hasn't been fixed. But even, you know, if you read what BHP thinks and if you read what Vale thinks and what Rio thinks, none of these people think that this situation will last. This is very evident because none of them have got any capex plans to increase supply. It just tells you that they don't believe that it's going to last either. So that's the iron ore side. On coal, which is kind of related to that as well, you need coal and iron ore to produce steel. The outlook for that is also, as we mentioned. Now, China has obviously blocked direct purchases of our coal, but we've simply managed to redirect that to other nations. So it's just been this reorganizing of a chess table that's occurred over there. But because our coal can't be purchased by the biggest purchaser, we don't attract the same premium right now. So the coal producers aren't quite getting the same prices. But from Australian purposes, on a macro scale, these aren't big figures. In LNG, with the very accelerated timeframes now that we're talking about carbon transitions and so on, LNG looks like a pretty solid transition fuel. I mean, it's very hard to create scenarios, if you like, that keep the world having sufficient energy whilst decarbonizing on a 2050 timescale without LNG still playing a very significant role. Now, it may not grow, but Australian LNG is perfectly positioned in terms of where we get it from, obviously our own territory, but we've got this really, really nice sort of geological setup that allows us to get the stuff out of the ground, put it on a ship, and get it to places like Korea and Japan, whose plans require 20-year contracts or thereabouts for LNG. So that's looking really solid from our perspective. And then the last thing that gets a lot of attention, I suppose, is copper, which is now, it's gone up 20 or 30%. It's now over $10,500 per ton. That's a really big number. In and on its own, it's got a couple of features in there as well. Firstly, the nature of the people extracting copper from the ground. The easy copper, there's sort of stuff you can get hold of quite quickly. That's largely being exploited. And then you get the stuff that's really hard to get. It's going to be very expensive to get that out of the ground. And we're in a situation where the prices of copper have got to rise quite a bit more to encourage people to go for that really hard to get stuff. So we're in that situation. And now with the election in Chile and issues in Peru, we've got supply side problems as well, climbing into the same problem. But I think that copper is also part of a wider picture. So we're now talking about electrification of energy and energy supply. So with our commitments, if you like, to an increasing support of a low carbon future, you can't get there without electrification of a lot of different things. And this means demand for lithium. It means demand for nickel and assets of that nature. Things that cause that sort of like help store batteries and transmit energy. That's in a super cycle.
Great, thank you very much. And just returning back, to a domestic focus, are you able to talk a bit about the term funding facility? Firstly, just explaining what it is, and then also, the implications of it winding up.
Sure, Ken. So basically, this was one of the key measures that the RBA brought to the table through March and April, and essentially. The plan was that the Reserve Bank would allow banks to borrow at a rate of, it was 0.25 initially, but now 0.1 for a period of 3 years, okay? There was a dollar amount initially assigned, I think that was around 75 billion, but they had the ability to increase that sum basis the nature of that lending. So essentially, if they lent money to small, medium enterprises, they had the ability to borrow up to 5 times that amount at 0.1. So it was a real incentive to get banks to lend to the corners of the economy that's sort of missing out. But also what it did is it provided an enormous liquidity injection. The other part of it was that it actually coincided with a period where bank liquidity rose super normally because none of us could spend our money. So whether it's the fact that no one could travel overseas or couldn't engage in normal entertainment, you essentially saw domestic deposits increase by almost $250 billion from the beginning of 2019 until recently. At the same time, lending's probably increased by about 16 billion. Okay, so net, there's an amount of $220 to $230 billion worth of excess liquidity just from excess saving. Then you add the term funding facility on top of that, and now you've got a significant number of additional liquidity that's hit the market. And how it manifests itself is in the most obvious way you could think of. There's too much liquidity, so banks are flush and they don't necessarily need your money, and they certainly don't need each other's. So the bottom right-hand corner there, you can see the chart for bank.swap, and you can see that that's basically at zero. And essentially that is that can be a measure for risk, but also it can be a measure that provides an indication of the cost of liquidity between banks. So essentially, banks have more than enough money, and they don't need each other's, and they also don't need ours. And we know that because, of course, what we can see is that the special term deposit rates have continued to decline, and most of your clients, I'm sure, or our clients would have complained or raised concerns at some stage about the fact that the available risk-free rate of return is almost non-existent, especially if your money's in an app called cash account, or I think your 30-day term deposits, you can get about 0.3% from some bank most of us have never heard of. So that's just where we are right now. So essentially, that was the intended purpose. Because of course, what we know is banks can get really, really hurt, and their customers and their shareholders can get really, really hurt when they can't find liquidity. So it was the right thing to do to provide them with as much liquidity as they needed and then some to preserve confidence within the marketplace, which was mission accomplished there. But now we're sort of dealing with the consequences of it, of course, because all that money's got to flow somewhere. So, for the first time, we're starting to realise that there is a cost in doing nothing. I'm sure that clients are feeling a great degree of frustration that they are being punished for keeping their money on the sidelines. Okay, so there is a natural corralling effect to move the money into the market or into an at-risk position. And of course, that's flowing through to a lot of the markets we operate in as well. Ken touched on initially around how risk-free assets have heavily benefited from QE, which is what the TFF is. It is a form of the term funding facility, is a form of quantitative easing. So, what we've got is we've got 5-year bonds issued by major banks. Right now, they'd be trading at a level of around 35 to 40 basis points over bank bill swap, which is at zero. Historically, they've offered closer to 0.8 to 1%. Okay, so this rather complicated chart. If we look at the top left-hand corner, the third box plot there is 5 years. So the red vertical line there is the median over the last 5 years, and the little X right there almost at the outer end of the range on the bottom there is where that spread is currently. So look, long story short, you are not getting compensated very, very well in senior unsecured bank bonds because, again, the banks don't need to issue paper to raise money. They don't need to borrow. So we haven't really seen any meaningful bank issuance from a senior unsecured standpoint for almost a year now. And what that means is there is just a shortage of assets because, of course, bank debt is a really, really big part of the market. So if the banks aren't issuing, well, the water will flow, the liquidity will flow elsewhere. So the second top right, you can see the box plots around the spreads for Australian bank subordinated debt. So if we look at the 5-year or the third box plot, which is the average for 5-year subordinated debt issued by a major bank, the red vertical line is at around 2%, which basically states that what that's saying is that historically you've gotten about 2% over the bank bill swap rate for 5 years in this kind of instrument. Right now, you're getting about 1.35% over the bill rate. For 1 year risk of that kind, historically you would have gotten about 1%. Right now, you're getting about 0.4%. Okay, and if you look at the chart on the bottom right-hand corner, you can see that that blue line has really diverged from the others. Okay, so people are really looking for alternatives to soak up their liquidity. For context, 1 year bank senior unsecured paper is historically giving you about 0.4% over bills. Right now, it's giving you about 4 or 5 points, 0.04 or 0.05%. So these are the most widespread or largest parts of the market. This is the largest part of the index, and they're not issuing, and there is so much liquidity at the same time. So the liquidity is going to flow everywhere else. And it's what we were talking about earlier in that a lot of the related markets are now being affected by this excess liquidity. And what we've seen is we've seen their capital prices increase materially in some cases. That's why a lot of the returns you're seeing in credit across the markets have, even though it's treated as income for tax purposes, there's a capital component, okay, which basically means that the yield expected from the market has reduced, which means the value of these securities has increased. Okay, so that's unlikely to be replicated in the coming year because of how strong that's been. So essentially what Ken was alluding to earlier is there are still plenty of opportunities to find yield, but what we don't necessarily want to be doing right now is betting on credit tightening a lot more than it has, because that is starting to get quite tight and expensive as a trade. Okay, so the term funding facility, in essence, 30 June this year, it starts to get unwound. We will start to see banks essentially come back to market. And as they come back to market, those spreads will start to widen naturally, because that's where they've gotten to without anyone issuing paper. So it stands to reason that when they finally start to come to market, you can expect a widening of sorts. Now, in line with what we said earlier, there is so much excess liquidity and the economy is in such good shape, it's unlikely you're going to see an explosion wider. It's not something that we're really concerned about. We don't think that it is an alarm bell situation where we need to make ourselves a tiny target, but by the same token, we just need to position the portfolio in such a way where we're less reliant on capital appreciation, for want of a better term, and more focused around generating yield off those available opportunities in markets like RMBS and ABS, for example, and even in Bank Tier 1, short-dated Bank Tier 1 looks interesting as an opportunity set right now.
Great, thank you. Just another macro sort of question. We're seeing, in the paper, a little bit about labour shortages. So, firstly, is there a shortage of workers currently, and when do you think this will start to flow through to wages? And furthermore, will this lead to a pickup in inflation? And just your views on whether we're going to see it above the RBA target of 2 to 3%, for a sustained period of time.
Okay, so labour shortages are an issue that's propped up in the United States a lot recently, because they've had huge demand for labour, and they had a very weak employment print just a week and a half ago. So it led to people believing that so many jobs out there, you can't get labour. You've got places like McDonald's increasing wages. Sorry, Brock, it's a different slide. There's an employment slide. I'm just waiting for Brock to get to the slide.
No, it's all right. I think I've jumped around some of the questions.
We're good, Kane. So we're just making sure that everyone can see and follow from the chart. Look, in the United States, there is thinking like that. The evidence is actually very mixed. All right. So what we do know is employment growth in just the last month was extremely weak, but the month before that was really strong. So let's not read too much into a single month. What we are finding for sure is that a new claims data, which is people who just recently lost their jobs, that figure actually is coming down a long way. It's absolutely consistent with an enormous amount of labour growth going forward. So we're on the path of getting a lot of people back in jobs. Both the Fed and the Treasury, if you like, or the United States federal government, if you like, is totally committed to full employment. So one of the things to note that's coming out of COVID is a really big change. Okay, so since the 1970s, just to kind of go on a big tangent here, since the 1970s, inequality has become a very, very big problem around the world, as we'd all know. And when Obama came in the United States, his promise was to actually address it, but he didn't. It actually became worse. So you end up in a situation like, with Trump, with storming of Capitol Hill. There's an entire demographic of displaced middle-aged white men, if you like, who feel really ripped off by what's happened. You've got Black Lives Matter. There's really big social problems going on in the United States. So what you're seeing now is financial institutions like the Fed are actually targeting full employment very strongly. So almost like whatever inflation is, we're going to take it because we've got to get people back and have an inclusive environment in the economy, because the alternatives are worse. So that's for real. So we'll have to see about this sort of labour shortage issue. What we're looking at there is that the unemployment benefits that have been now promised currently exceed the minimum wage payments of many jobs. So you can see that people just don't need to go to work as long as they meet the sort of unemployment criterion and still get those checks. They're actually not encouraged to go back to work. Those things come to an end in the United States in September. So we'll see where we are on that front. There's actually a very mixed evidence on that front. The other things are that childcare, for example. So if you're a woman with young children, if you can't know that you're going to get a job and you have stable childcare, you can't take that job. So right now, COVID's still, in a bit of flux in the United States, and people aren't terribly confident that their situations will be stable enough to re-enter the workforce. So that's definitely an issue. And the other thing is that people still are concerned about COVID. So you're finding that high contact type of jobs, there's still a lot of reticence to go back to work for the time being, but that will be addressed as the counts are coming down, as they are in the United States, and their vaccination programs are rising. Now that leads me to this chart here, because I'm going to spin into the Australian unemployment and wages, but through this chart. So the biggest question in Australia is, when will wages get to above 3%? Okay, so that's actually the trigger point when cash rate should start to rise. It's at least at that level. We haven't had wage inflation at 3% for over 5 or 6 years. Every prediction that the RBA has made, in fact, also the federal government and most predictors, would have had that returning back to 3.5% through every time they forecasted it, but it never has. So the models are all broken. So what do we know? We know that before COVID, we had an unemployment rate of about 5.2, and we had wage inflation nothing like 3%. So if our models are broken, what are we going to use as references? Well, we can look to the United States and the United Kingdom because they're somewhat similar economies, and let's have a look at what they did. So on this chart, the sort of top lines, the ones with dashes on it, they're the unemployment figures for the US and United Kingdom. Doesn't matter which one's which, they were overlapping. And then the bottom lines are the rolling 1-year wage growth for both those countries. I've circled the only time in the last decade that or last several years at least, that the wage growth actually met what de Bell's statement is a minimum condition to raise cash rates, which is around about 3.5%. That only occurred in both those countries when the unemployment rate fell below 4%. Okay, so if that's to be taken as a guide, and these figures are actually quoted by the RBA and somewhat alluded to by the Treasury, but not quite to the same extent, then that's what we need. And the sorts of things that have got to happen to do that are in no one's forecasts. The RBA's forecasts in the Statement of Monetary Policy just released and in the budget just released don't see those figures happening until 2024. So at that point, we're still not seeing any call for cash rates to rise for at least another 3 years. And unemployment's got to come below what any of those projections are saying for the conditions to be met. So you're looking at cash rates not rising for quite a bit, for many years, possibly through beyond 2024 at this point.
Great, thank you. You touched briefly on vaccines. So all these new variants we're seeing, how do they sort of play into economic models and outlooks? And how do you sort of account for them?
Yeah, look, in the post period, like certainly in Q4 of last year and into this year, the market was happy to look through things like huge surges in COVID breakouts in Europe and so on that caused a double dip recession. The market never skipped a beat. Okay, so clearly the market was already looking through near-term deviations in in economic outcomes on the basis that everything will be all right in the end. At some point in Q4 this year, all economies should be back, above where they were, pre-COVID, at least the Western world. In many cases, including Australia, we'd be sort of baselining into a previous trajectory by about 2023. And in the case of the US, straight through that with all the Biden packages and so on. So the market was just assuming everything is going to be fine. But what you're observing right now is this race between new variants cropping up, and these are really severe, and the uncertain ability of the vaccines to handle it. Now, it's waxing and waning, but just to give you an idea of the kinds of problems you're looking at, this chart here shows you a genomic study from the CDC, the Centers for Disease Control in the United States. And what they've done here is had a look at the genes of all the COVID variants that are floating around the United States. And you can see that sort of like mauve colored, bar that's taking over the whole thing. That's the Kent variant. Like it was nothing at the start of the year in the United States. It just made an entrance, and all the other variants were dominating and all that. But you can see that in a fairly small number of months, it becomes the dominant variant. Now, lucky for us, the Kent variant gets handled very well by AstraZeneca and Pfizer and all the major. It's fine. It stops people from dying. You're not going to see a flood in hospitals. You won't see a spike in deaths if you've got good vaccine coverage. So we're okay with that one. But what about the South African variant? You'll see this little P1 down the bottom there. Now that P1 is kind of like where the B117 was a couple of months back, right? This is the South African variant. AstraZeneca doesn't do a whole lot for that one. So if you're in Australia, where 50% of our population will be AstraZeneca, if we end up getting enough vaccine coverage, you're effectively unprotected if the South African variant comes into Australia. So we're sort of in that situation of doing things, but Australia at the moment is actually very exposed, which is why we can't open borders. We just can't do it because of situations like that. We are effectively unprotected at this moment, which is why the borders are kept very, very tight. And, despite all the controversies, the risks are very, very high. Just today, to give you an idea of what the government's actually thinking, just today it was published that the head of the Treasury just released, if you like, what their estimates were for net migration coming in. So people being able to enter the country again in the way we used to do before COVID hit. They're not forecasting a return to normal levels until 2025. to give you an idea of what we're looking at here. So what that means is, look, the economy can recover internally. Global movement of people is still a long way off. That's partly a problem in Australia because our vaccine mix is not ideal and because our take-up rates are so low. So you're not looking at any return to normality, for many, many years. We will have forgotten what normal was by then. But there is plenty of good news because they can adapt. The platforms to deliver these vaccines can adapt quite quickly. But look, even AstraZeneca, for example, to create a new booster, they can probably get the formula right in a month. It takes about 2 or 3 months for safety testing to take place. Then they've got to produce it and get it into your arm. Okay, so that lag is 6 months. Take a look at this chart, and it shows you what happens in 6 months. That's the kind of race that we're in. It's not a great picture.
I might just add to that as well. So, the other flow down impact for us as credit managers as well is a lot of the modelling around remediation of balance sheets and getting back to some form of normal around credit metrics. There's also still risk relating to that, right? So whether it's the numbers around how long it takes for airlines such as Qantas to get its balance sheet back in line with triple B or investment grade metrics, or airports for that matter, or the potential for re-emergence to affect retail assets, for argument's sake. All of these things need to be considered as well, because of course how we got through COVID was a lot of these companies took down a lot of liquidity to protect themselves and buffer themselves over that 12-month period. And in many cases, a lot of that money was spent just surviving, So I guess the impact for us from a bottom-up perspective is that it means we have to remain vigilant in terms of how we're projecting for recovery within the metrics of the credits we invest in. And it does drive a degree of conservatism around the ability for these balance sheets to be remediated to a point of where they were pre-COVID. And the reason why that's important is that this is coinciding with a period where this credit is as expensive as it's been in a very, very long time. So those things don't necessarily reconcile. I mean, what we do know is that the economy is, in general terms, in pretty good shape. Banks are fine. A lot of the concerns around the defaults and arrears around residential mortgages have largely dissipated. We've got a robust property market, and we're very, very comfortable with the property market as well over a short to medium term standpoint, also despite challenges around migration and otherwise. But it means there are certain sectors that are likely to fare a lot better, and there are still other sectors there where there are lingering risks. And it's important that we keep our wits about us and not get to the stage where we start to really materially discount the prospect of things going wrong. Because again, to reiterate, a lot of these businesses are carrying a lot more debt now than they were pre-COVID.
And just to wrap up on that question, the way we're not massive, we're not like central case all fear and doom on this, but there's always the possibility that you end up with another sort of flare up because of an unprotected situation given our vaccine mixes, and as I mentioned. So we do have some protections on our portfolio that are designed to capture something happening in the domestic economy that's not a global issue. So the sorts of ways we do that is to, for example, if something happened in Australia that was unique, what would happen is the Australian bond yields would fall versus the US bond yields. So we have a position that will add to the portfolio if that event was to occur. And similarly, if something happened in Australia that didn't, wasn't a global issue like a vaccine rollout like this going wrong, you'd find the Australian dollar would have downward pressure on it as well. So we have those sorts of positions inside our portfolio in the event something like this was to turn up.
Thank you. Andrew, you touched briefly on housing domestically. How problematic are the extreme month-to-month rises that we're seeing at the moment?
Not particularly problematic at this stage. I think, this is, you probably have to go back a couple of years just to get proper perspective and context. We had a pretty weak 2018. A lot of the talk around negative gearing and the affordability being used as almost a election platform or a core election pillar by the Labor government certainly had an impact of weakening the property market. that was after a period where APRA had really tightened up its lending criteria and indirectly forced a reduction in interest-only investor-type lending. So you had a market that was reasonably soft for a period of time. 2019 came through, market started showing some signs of recovering and getting back to its old trajectory. Through that period, we also had some real, strong changes around serviceability criteria. So all of a sudden, anyone who's gone for refinancing or gone for a loan knows that expense based is now being looked at very, very closely. The flow of credit essentially slowed down. And as 2019 worked through, we had bushfires hit us late 2019, which almost gets forgotten now because of COVID. So you had the property market really didn't have the opportunity to recover strongly from that weaker 2018, 2019 period. And then COVID hit. So in many ways, you could describe some of what we're seeing here, a degree of catch-up. When you're looking at the market, you're looking at obviously borrowing costs are at record lows. Variable rate mortgages are under 2% right now for a lot of borrowers. We've got household savings by virtue of the pandemic have been reasonably high. The level of increase in household debt has been on hold and has been low by historical terms in terms of the rate of change there. So households did a great job in sort of remediating their balance sheet over that period, combined with a period of weakness pre this most recent uptick in property prices, and now it's been combined with a potential increase in wages across the marketplace as well. So you combine all of that together, and look, we don't feel that what we've seen so far has pushed us into territory that would be described as being problematic. That said, it's plausible that as this year goes by, we get to a stage where the increase or strength starts to flash a red marker on the RBA's panel. And look, at that stage, what happens? It's an interesting question. The fact of the matter is that we've seen globally and here in Australia that macroprudential levers can work really, really well in slowing things down and softening things a little bit as well. But I think in the meantime and in the shorter term, I think it's entirely within the RBA's and the economy's interest for people to feel constructive around property prices. I think it adds to confidence. I think it adds confidence around consumption. I think it adds confidence for people to engage in home improvements and a range of other activities which provide a positive multiplier for the economy in general. So from that perspective, no, it's not a concern. It's actually a benefit. If it runs too far, they've got levers they've used before that have been quite effective without necessarily needing to lean on monetary policy, is probably my other observation. I don't know if you want to add anything to any of that, Tim.
Yeah, so look, from our perspective, for our portfolio, we're invested in property indirectly through residential mortgage-backed securities and also through bank debt. So our concern is making sure that those debts can be repaid. And so the things we're looking at there is the possibility of a really, really bad property crash, and then a lot of people becoming unemployed and unable to pay those debts. That's the concern that we have. So some of the things that matter to us is that if you look at the ability for the households to repay, yes, they're taking on more debt, but we've got a couple of things that are happening. Interest rates are really low right now. So the bottom left-hand side chart shows you the affordability of at least making your interest payments, not your principal. And obviously, it's going to be harder, right? But overall, they can make those payments. And the tests that banks are putting through nowadays, because they know that APRA is all over them, they'll watch them, all the loans, all those practices. The stress test they put borrowers through is actually very significant, and it can tolerate something like a 2%, 2.5% increase in mortgage rates from where they are today, and they must still be able to make it at a minimum. And most people, I'm talking 90-95% of people, don't borrow to that level. Okay, so of the fresh money, let alone the money that's already substantively paid down, that's looking all right. And although we're borrowing a lot of money, if you look to the right-hand side chart, the property values have gone up. So in the event they can't pay, you're likely to still get a good price for your property, and you're probably going to come out whole anyway. So, them and lots of other things I could talk about. I guess I'll just talk about one more. The entire might of the RBA and the Australian Treasury is being put towards keeping people into jobs and getting more people into jobs. The whole country is about employment right now. If you were to say the one thing that matters most is getting everyone back in a job and getting everyone who possibly wants to work into a job and getting them all pay rises. That's the number one objective, quite clearly. So for the next 2 years, if you know that's going to happen, I am not concerned about the immediate outlook for the next 2 years of those assets. What happens in after those next 2 years, we'll see what the property market got to. But the strength of banking in terms of the bank capital has never been like this before. So we can sustain something like a Great Depression. I'm talking not the GFC, I'm talking the Great Depression. And the banks would still be plenty functional. So that's the strength that they've got right now. And so we're quite happy to be exposed significantly to certain portions of that market.
Oh, thank you very much. That's all the questions we've got time for today. So thank you, Andrew and Ken, and everybody listening at home. I hope you've gained some valuable insights and enjoyed hearing from Realm. If you've got any more questions, just feel free to shoot them through and we'll get to those. Do also keep an eye out for an invitation going out shortly for our next fund manager webinar. But yeah, last, I'd just like to say thank you again, and I hope you enjoy the rest of your day.
Thanks, Kate. Thanks, everyone. Thanks for the opportunity.
Thank you.